Okay, it's 12 noon, everyone. Hello, everyone. Thank you for joining us. I'm Debbie with TSIB. Welcome to the first day of TSIB's Construction Risk Management Seminar. We are so excited to be here with you today. I'm going to introduce our first panel moderator in a moment, but first a couple of housekeeping notes. While our sessions are pre-recorded, both our panel discussions are live. We ask that you stay on mute and off camera during the panel discussion. During the panel discussion, if you have any questions, you can post them in the chat feature located on the top right of your screen. We will be answering all the questions at the end. This entire discussion, including the Q&A, will be available on demand on TSIB's YouTube channel. Lastly, the material covered during all our panel discussions and session presentations are for informational purposes only. It should not be construed as legal advice. It is highly recommended you contact your attorney for legal advice. So without any further ado, I'm going to introduce our first panel moderator. This is Nick Langer, a senior risk advisor at TSIB, and he will be leading our panel entitled State of the Insurance Market. We are so excited to have you here with us, Nick. I will now hand it over to you to begin.
Thank you, Debbie. Good morning or good afternoon, folks, depending on what part of the country you're currently located. Thank you very much for joining us in this first session at TSIB's Spring Virtual Risk Management Seminar. As Debbie mentioned, my name is Nick Langer with TSIB. And joining us today, we have Jeff English, Office President for CRC Insurance Services, and Glenn Pine, Director of Market Development with TSIB. Before we dive in, I'd like to let you folks introduce yourself real quick. So Jeff, do you want to say hi to everyone and let us know who you are and where you've been?
Sure, sounds good. I appreciate you guys having me. I'm honored to be here and kind of share what insights I have. I work with Nick and his team in placing casualty business, largely in the West, but also throughout the country. My background is I was a wholesale broker and later principal and executive vice president for W. Brown and Associates, an independent wholesale broker that then became a CRC company at the end of last year. And I now run our office here in Irvine, California. And me and my team place largely construction business, focused in the casualty line of business.
Thank you. Glenn, you want to introduce yourself to the folks and let everyone know who you are and where you've been?
Yeah, hey, good morning, good afternoon. My name is Glenn Pine. I've been with TSIB since 2007. Currently, I am the Director of Market Development, dealing with the markets and just being in touch with the underwriters and what's happening kind of out of broad brush. And I started in the business as a consultant and went into brokerage soon after finding a home at TSIB. I'm happy to be here. Thank you.
Thank you. So today we're going to be discussing the ongoing hard insurance market. The construction industry has many challenges, including small profit margins, labor shortages, job site safety, and another compelling challenge these days that contractors need to deal with is operating in this current hard insurance market, which is making it very difficult to obtain limits at affordable pricing. And some of you may be asking, what is this hard market? And in short, insurance companies typically make money in two ways, right? There's underwriting profit and investment income. A shift to a hard market is triggered when those money sources are distributed, specifically, or I shouldn't say distributed, when they're disturbed, specifically when a few things happen, right? When there's falling investment returns for insurance carriers, which impacts their profitability. We've also seen increase in frequency of claims and also an increase in severity of claims. And some of the things really driving that, without getting way into the weeds, we've had a lot of natural disasters that have impacted the insurance industry. We also have this concept of social inflation, which is driving up the actual settlement value of claims. We've also had a lot of regulatory intervention. So in today's hard market, contractors now face a very high demand for coverage and limits and a very limited supply for those same coverage and limits, which is what's driving rates up ultimately. So we want to kind of dive in here and expose some of the folks that are joining us today to kind of understand more of the inner workings of what's happening and where we're going. And I know I can speak for myself, and I predominantly am focused in the Western United States with my clients. And, you know, different regions in the country we know have different risks, right? There's different hot buttons per se. You know, on the East Coast, where, you know, New York-based contractors have more of a difficult time obtaining affordable general liability, excess liability coverage, where typically on the West Coast and specific to California, you know, we have contractors that are more focused on their workers' compensation rates, right? So we see different things happening in different parts of the country. And a lot of our clients have gotten, fortunately, through this. There's been some pain along the way, but it's very hard as a contractor operating in this hard market, because we're bidding projects today that won't start for 6 months, potentially a year, especially if you're doing any public works projects. Those jobs tend to be delayed or pushed out even farther. So it becomes extremely challenging for contractors to effectively bid a project with their insurance costs they have today, where we're seeing, and obviously you folks will confirm that, you know, rates continue to go up. So the, you know, the cost per thousand or percentage that you're charging, that you're pushing through in your bids for your insurance costs, it's constantly going up. So it makes it very difficult to bid these projects without taking a loss on the back end. So I'm just going to ask a broad question to both of you, and I'll let you go one at a time here. But in your opinions, what coverage lines have been most drastically impacted by this hard market? Glenn, do you want to jump in, and I'll let you start?
Well, sure. You know, I think that for the most part, the excess liability market has been impacted most severely. You know, that's essentially, you're seeing a lot larger judgments. That's creating loss payouts that that were not really anticipated in the pricing, and it has caused the market to pull back on their capacity, as well as increase their prices to counteract those payouts. And that has ripple effects throughout, you know, many industries, particularly construction. Another one would be property, due to the major catastrophes that we've been experiencing. Again, also a pricing issue, and one that came up rather suddenly is the cyber insurance. With the pandemic and everybody being forced to work from home, cyber crimes are through the roof, and I don't know that the underwriters had really anticipated the level of loss that they're seeing as well. So those would be the three areas. I'll pass it off to Jeff if he wants to add.
Jeff, do you have any feedback on that?
Yeah, I appreciate it. I totally agree. I think excess is kind of first and foremost the one that is experiencing it the worst, and that probably doesn't come as a surprise to those that have experienced it firsthand. The less capacity, tighter appetites, increased rates. Carriers that were offering 10 million are now offering 5, or 25 is becoming 10. People are moving up in the tower. Where it's taking longer as a result, because we have to get more carriers involved. The price is obviously going up. And as a result, we're seeing kind of a trickle-down effect where carriers can be more selective in terms of the risks that they're taking on, and may not go after the auto fleet that might have a couple of bad losses that are into the excess. And as a result, it kind of compounds it. One of the, commercial auto is another area that wouldn't come as a surprise to anybody that's been getting rate increases the last few years. Unfortunately, it sounds like that the rate increases haven't helped kind of with the deterioration over the last few years. And so we're continuing to kind of see that go up. Glenn mentioned a couple of catchwords that we're hearing a lot: the social inflation, the nuclear verdicts. Without tort reform, I don't see that kind of going away anytime soon, unfortunately. One area that I think might not go overlooked, but wasn't mentioned, is the course of construction market, and specifically frame COCs. Our team places a lot of frame business here in California and the West, largely kind of apartment buildings and similar. But the rates on that have more or less doubled over the last few years, with higher deductibles, especially for water damage, increased requirements for security. They're tightly underwriting the general contractor experience. And then anything that has like a brush fire or catastrophe exposure to it is also getting more and more challenging. Any extensions need to be negotiated up front, because any trying to move one of those midterm or get an extension when the carrier is not interested in doing so is exorbitantly expensive. We're seeing carriers try and charge back the entire length of the project, not just the extension, and it's becoming very, very difficult. So those would be kind of the three that I would see.
That's I mean, from our side, from the brokerage side representing insureds, that's typically what we're seeing, and we're encouraging, because of those reasons. If for those of you listening, I mean, we're encouraging our clients to have discussions with their clients as early as possible. This isn't something that's obviously isolated to any region or territory in the United States, right? This is a nationwide thing. It's a global issue, but it's a very much a nationwide thing. And we do have some of our more progressive clients are having conversations with municipalities locally, where there's requests for higher towers, and there's projects that were maybe bid 18, 24 months ago and now are just starting. And there's a challenge because the cost of a $10 million tower 24 months ago is nowhere near what the cost of the $24 million excess tower is today. And it's as you mentioned, it's very challenging, and the carriers are unwilling to obviously make accommodations, for lack of a better term. With that said, something that's been challenging across the board, and I think this is something that the folks listening today need to be aware of, is it's not so much necessarily rates that have increased, right? Rates have obviously increased, but in addition to that, it's impacting the process of underwriting and obtaining insurance in general, right? So in both, Glenn and Jeff, I'll flip to you on this one first. How has this hard market actually impacted the underwriting process itself?
Yeah, that's a really good point, and something we kind of touched on briefly earlier. But the first and foremost, the process is slower. Rates increase, people shop around, want to see what's causing it. Word gets out, that kind of accelerates. A lot of our underwriters are saying that their submission flows doubled in the last year or two. And there's just not enough time to get to all of those. So it requires multiple follow-ups. It requires getting out early. Less capacity means, more carriers to accomplish the similar. So if you have a $40 million tower where you might have only had a couple of carriers involved before, it's now requiring more people. Second, I'd say the kind of underwriter attitude and dynamics has kind of shifted a little bit with the hard market and rates going up. Underwriters can be a little bit more picky. They don't need to kind of stick their necks out on the tougher, hairier, more borderline accounts. They can get rate increases on their existing book and kind of re-underwrite their book as they go. So there's also those two things kind of work in tandem. There's a little bit less tolerance for stuff that is not well prepared and not well presented. So information and kind of communication becomes key in those situations. Addressing any sort of warts and getting out in front. We're seeing small changes too with different things like lookup provisions where an excess carrier wants to see all the other limits being provided by others in the tower, and the attachment points are changing and retentions and some of the other things. But yeah, I would say the process, the communication, and kind of the underwriter dynamics are key factors that we're seeing.
Glenn, from your perspective, you work with some very large contractors, national contractors. I mean, What have you seen? How has the hard market impacted the underwriting process from your perspective?
Well, I think Jeff is absolutely right with what he's saying, and that's big account, small account. In a lot of instances, there are obviously, when you're dealing with a larger account, you've got more premium, so there's a little bit more of a hammer, so to speak. Relationships are obviously, relationships are important in any business, but in this business, it seems like it's, certainly the touchstone to everything. So those long-term relationships, if you've got a long-term relationship with a carrier, moving your business to save a couple of dollars may not be the right thing to do. Obviously it's all dependent on the specific circumstance, but there's a lot to that relationship piece. Going back and dealing with the underwriter, there's more talk, there's more underwriting happening, discussions about losses, how the losses affect the account, what that actually means. That all of that is extremely important now, because while there's definitely a hard market, there is still some flexibility, and you can tap into that and make make a bad situation a little bit better. So that relationship piece is key. You're also seeing exclusions that are being added to the policy. Coverages are being pulled back. Again, if you have the opportunity and the ability to talk about the issues, maybe you can limit the effect of those exclusions, or find a way around what's being proposed. I don't know that it's changed the way we do business as much as it's made it more important to actually pay attention to what you're doing. In a soft market, you kind of just throw everything out, and it comes back, and you get what you get, and you can push price. But here it's more important to really have that submission in good shape, to really have an engaged underwriter, because as Jeff said, the submissions are up so much that it's very easy for the underwriter to take the file and toss it over his shoulder, because he's got 50 more on his desk and another 50 coming tomorrow. So that's the key.
I want to stay here for a second, because both of you brought up two really good points, right? And ultimately, we're from our perspective, we're dealing with our clients, and we're talking about the concept of the contractor ultimately being a risk, right? They are either a good risk or a bad risk, right? I mean, that's ultimately what this whole process is, right? Is for it, and we're taking someone's specifications, right? Billy Bob's Contracting is now being presented to an insurance carrier, and the underwriter has the ability to make a determination whether or not this is a good risk for the insurer to take on, or a bad risk. And there were two things that you said. Relationships are obviously a big deal, and preparing a complete submission, right? A complete application with all claims detail, the whole narrative. And I just recently had a client ask, we've been doing business for 10 years together, and why are you asking all these extra questions? You've never asked all these extra questions. And the answer was, well, right now it's very challenging to obtain affordable coverage, and we're trying to do everything in our power to present you as a good underwriting risk to the insurance company. And I'm going to go off on a quick sidebar here, but Glenn, you brought up a good point about making a move right now over a couple dollars. I'm going to flip something to you right now, Jeff. There's fluctuation in pricing with any market, right? Whether we're in a hard or a soft market. And to Glenn's point about making a move right now, is there anything to be said from an underwriting perspective in the sense that an insured who has been with the same insurance carrier for say 5-7 years, does that carry more weight? Does that carrier have more interest in staying on that risk right now, or maybe potentially giving more preferential rates because they understand that contractor's operation is a risk, rather than jumping from carrier to carrier right now in a hard market where maybe the new insurance carrier is kind of going out on a limb to accept this new risk where they really don't know? And do you have anything to add there to that by any chance?
Yeah, I would certainly reiterate that sentiment. Carriers that have been on an account for a long time have inspected it, they've audited, they've interacted with the insured, they've gotten information year over year, work in progress. They have a comfort level. I mean, they're risking capital to provide insurance to these, they're presented with information. So it's not an unknown, but the more comfortable they get with an insured, and that, it's a relationship, it's built over time, the more they are willing to kind of make accommodations, help out, and like in any relationship, I mean, you meet somebody once and you might help them out a little bit, but for a friend that you've had for years and years, you're more willing to kind of help out, for a better lack of a better term.
I love that, and that's a great analogy, and that's something that we do discuss. It's a hard concept, I think, for a lot of contractors to grasp, because contractors live in a bidding world, right? And insurance is not so much something it's a hard concept, in my opinion, for contractors in particular to comprehend the process of obtaining their insurance, and as Glenn and you both mentioned, right, the relationship and developing that relationship with a carrier so that we can weather the storm together, versus the mentality, which I think a lot of folks it's second nature to say, oh, I'm going to get a bid for my insurance. Where right now, when we're going through a hard market, I can tell you firsthand with some of our clients, and obviously both of you will probably reiterate this, the ones that are demanding making a jump every single year to a new insurance company right now are having a very difficult time obtaining affordable coverage. Whereas our clients that have said, we've found the right carrier, we've rode things out with them for a period of time. They understand us. Maybe we've had some losses, but the premium paid over the last 10 years versus the losses seems to be a mutually amicable, beneficial relationship with the insurer and the insured. So I appreciate the insight. So as we start to, we're kind of at the midway point here, and I know folks have trains to catch and places to go today. So without holding a crystal ball, right? Because if you could answer this question, then we wouldn't be on this call. I think we'd all be calling in rich and sipping Mai Tais somewhere in the Bahamas. But without holding a crystal ball, where do you currently see the hard market trending? Are we still accelerating in the sort of negative trend? Are we seeing a point where rate increases are starting to decrease slightly, or have we hit any sort of plateau? And again, this is more opinion than anything, because we can't predict the economy. Jeff, do you have any insight from your side of the house?
Yeah, from where I sit, I would say we would kind of expect to see continuing hardening throughout the rest of the year. I wouldn't say it's accelerating. Last year saw some of the largest year-over-year price increases since kind of the early 2000s, but I would say we kind of, hopefully that will moderate late into the year and stabilize a little bit next year. Traditionally, the soft market cycles last longer than the hard market cycles, so we're already, a couple years into this one. So there's a lot of, as you mentioned, though, there's a lot of factors that are macroeconomic in terms of interest rates and catastrophe losses and all the rest, especially when you start talking excess and the reinsurance capacity provided. Those same reinsurers are the ones that are getting hit by the wildfire losses and the Gulf hurricanes and all the rest. So yeah, it's I wish I had a crystal ball, but from my perspective, that's We are seeing some additional capacity coming into places like Bermuda with different MGUs getting set up, and they're mostly opportunistic currently with things like electrical contractors working for wildfire and stuff, but they are providing capacity lower in the tower. You know, traditionally they were kind of a Fortune 100, Fortune 1000 play, but hopefully that will kind of continue, and that additional capacity will help with the hard market. So.
Thank you. Glenn, what are you seeing from you're interacting with insurance carriers all the time on a larger scale, or I should say with larger clientele. What are you seeing right now? Do you think, are you in sort of the same opinion as Jeff, or?
Yeah, I think for the most part, I think that if you were to ask this question a year ago, the answer would have been the market is hard and it's getting harder. And a lot has happened in a year. You're seeing insurance companies coming out with high earnings for their quarters. The pricing has been creeping up, significantly quarter after quarter. What's interesting is if you look at the reinsurance companies, they're just looking for more rate and more rate. They want to push these prices up higher. Traditionally with hard markets, there's been a couple of, the market's cyclical, of course. So, there's been a couple of hard market starts in the past 10 years or so. And typically what happens is the market starts to harden, pricing starts to go up, and then, all of a sudden it becomes like a head fake, because one of the companies usually says, oh, you know what, we can grab market at this rate, and they come in and they cut, they undercut everybody, and the next thing you know, that hard market that everybody feared just tumbled on itself. And obviously that didn't happen this time. I think that now you're seeing pockets of that occur. If you have, again, back to, previous conversation, if you have a good submission, if you've got a good story, there's competition that's happening. So there are cracks, some cracks in the wall, so to speak. But for the most part, I think that this market is going to continue to stay in this hard cycle, at least through the year. But again, if you've got a good story to tell, you might be able to find some better deals.
Glenn, you bring up a good point there, actually, on the head fake, and when we hit these hard market cycles, a carrier or carriers deciding, to try and use this as an opportunity to capture a large percentage of market share by undercutting the market. And sometimes we see this with a new carrier, right, that enters the marketplace, or they enter a new market segment. And I know in my experience, I'm always very cautious of the carrier that says, hey, now we're going to insure contractors, and we had a restaurant program for 20 years. And, I'm kind of being facetious here, but in all seriousness, I've always taken the position with a client, say, I don't necessarily always want to be the doctor's first patient, right? I don't necessarily want to be the first in line. And kind of going, sidebar here for a second, from both of your perspectives, obviously you're both experts in your field. If that happens, which we know that's going to happen, right? We can pretty much predict that at some point here in the coming months, we'll say, or year, some players will jump in, and it could be a carrier that says, you know what, I'm now going to lower my rates. Or we could have a carrier that, was the restaurant hospitality expert, and now they want to get into construction. I usually advise my clients, hey, let's kind of see how this plays out, because this carrier hasn't necessarily had the underwriting, the claims handling, right, the auditing. They haven't gone through that with contractors. So maybe we'll give that a little bit of time to see if this is a viable option and if this is a good fit. Is my conservative thought with that decision making? I mean, Jeff or Glenn, do you have any insight on that for, for folks when we see the XYZ carrier that jumps out of the, manufacturing space and dives into construction because they feel there's an opportunity? Do you have any input on that? Jeff, do you want to?
Sure. Yeah, I mean, especially in the general liability space, with it being kind of long tail business where you see, the claims aren't apparent right away like they would be with a grocery store where they're all slip and fall claims. Some of these construction defect claims are coming, 7, 8, 9, 10 years down the road. And so you might be kind of the hot market now, you might pick up a lot of market share, but if you don't know what you're doing and you're not, properly reserving those losses, then you're going to have to make up for it in a few years when all the bill comes due, so to speak. So it's not a place for the faint of heart, and it's not a place for for those that are kind of just visiting, so to speak. So I would 100% echo those sentiments.
Thank you.
I would agree. It's difficult to switch, to switch from manufacturing to construction if you don't really know what you're doing, and you do have to be careful. I would definitely look very carefully at the carrier, the company that's making the switch. There have been situations that have been successful. One in particular, large company opened up, XL opened up their construction practice, basically, formed it out of nothing. The difference there is they found very, very good construction underwriters and put together a team so that they had that infrastructure, and there, therein lies the issue, right? If you know what's behind the company, it could be a boon for you as well, because when XL started, they were breaking record after record for premium growth their first few years, and now they are a force in the marketplace in that construction space. It's very important to understand what's behind the move.
I think that goes back to something else Glenn said earlier too, in that it pays to have experts in what you're doing and people that have those relationships, because that's, you don't know where these underwriters are coming from if you're not familiar with the space. So being familiar with the construction space, knowing the background of these folks, having worked with them at prior companies, you feel comfortable knowing that they've had a successful track record and haven't kind of burnt bridges as they've gone along. So I think that's valuable insight.
So market's hard, right? Pricing's gone up. Contractors are being put. Jeff and I, you and I are on the phone frequently. We, hey, we have this project and we need 10 million, or hey, we need another 5 million in pollution or whatever it is. And, we're trying to build these towers, and it's difficult, right? I can obviously, between you and I, we know that we're having conversations about these situations with our clients, right? With contractors that need to get certain limits in order to bid a project, or we have a project specific that we need to get in place and we need certain limits there. Have you seen, from your side of the house, either of you, have you seen any sort of changes in buying philosophies or strategies from policyholders? Globally, you guys, we sit on the side of the client, right? We represent our clients. But from your perspective, you're dealing with various brokers that are bringing various clients to you nationally. Are you seeing changes in the way in which folks are trying to obtain coverage? Different philosophies? Gentlemen, I guess I'll let Glenn jump in here.
I think that there is a push to maybe pull back on limits. I think that's a knee-jerk reaction. Particularly if you're seeing, there have been some reports of 100% premium increases for some companies. You know, it's a very difficult discussion to have, because, you know, it's, you know, on one hand it's short-sighted. You know, if you were to have a loss, and you have now an uncovered loss, that becomes a balance sheet issue. But if you're paying for premium that you can't afford, well, you know, that's a balance sheet issue as well, just a little bit of a different balance sheet issue. But the point is that there's, you know, there's a push to reduce limits. You know, I think that, you know, this is again something that clients need to talk through and understand exactly what those actions would entail, and what that cost would be, and not just a dollar cost. You know, that's probably the most obvious result of this hard market.
Jeff, what are you seeing from your perspective?
Yeah, I would agree. When your limits, you know, become much more expensive, obviously the first reaction is, hey, I'll reduce those. But when you look at what is kind of some of the causes of that cost increase in the industry, with you know, single plaintiff verdicts being in the hundreds of millions, and some of these other things, it seems like that is potentially short-sighted. But you know, it depends on each person's individual risk tolerance and financial position. So that's a question we leave up to the insureds. But our benchmarking internally, with, you know, CRC writes over 10 billion in premium, and it does show that people are reducing limits. You know, not in mass, but to some degree. We've seen clients try and leverage better performing lines of business in order to kind of help with, you know, if auto's distressed, or, you know, they're kind of trying to get creative. On our end, we try and think outside the box. We try and readdress some of the issues, find out kind of what the must-haves are, what the nice-to-haves are, and what's kind of available to trade. You know, creative strategies too, like are you an industrial piping contractor or a solar contractor that could possibly find a home in the environmental markets, where you know, the market isn't as hard as it is for traditional contractors, and maybe excess limits are more you know, readily available. But it just comes down to kind of communication and knowing, you know, where each person's at, what's important to them, what their clients are requiring of them, and where we need to go. So
this comes up frequently, right? I hear from folks all the time. X, Y, and Z owner or XYZ contractors, you know, they're asking me for $5 million, or they're asking us to bring 10 million, you know, pick a number, right? Whatever the number is for their excess tower. And, you know, there's usually pushback, especially from your smaller and middle market size contractors. And, you know, something that we talk about a lot is there's, you know, we'd like to think, right? And we talk about this with our clients a lot. We'd like to think that the fact that XYZ owner or XYZ contractor has said, here's your contract, and we're expecting you to bring 5 or 10 million or 20 million or 30 million or whatever the number is to the table, an attorney or a risk manager or a team of attorneys and risk managers have somewhere, hopefully, sat around a table and had a discussion and said, well, this trade and this scope and this region, if something goes wrong, we think that we need to have this much in limits in order to respond to a potential loss, right? So in a perfect world, in a utopian world, a team of risk managers has sat down with the Turner Constructions of the world and the Swinnertons and the Kiewits of the world, and they've said, hey, if Joe Electrical creates some sort of an issue, we want you to have, we'll just say $5 million in excess limits. And I always tell my clients, they're not trying to put you out of business, right? You have to remember that you've indemnified your upstream parties. And if you don't have these limits, they're still going to enforce the contract, which is a very eloquent way of saying they're going to sue your pants off, right? So if we don't have the limits, we have a major financial issue, as Glenn referred to it as a balance sheet problem. So what we're encouraging people to do is have a discussion with those clients to explain to them what's happening and the pricing and the fact that, hey, you're asking for this coverage or these limits from me in my contract, but I might not be able to comply with that because of X, Y, and Z reasons going on in the hard market. So, and this is again sort of a general, and I'm going to direct this to Glenn in particular, but Glenn, are you seeing our owners and some of your larger general contractors, are you seeing that they are more willing to negotiate some of these contractual items in order to keep a specific trade contractor working, or because they have maybe a couple key, maybe it's critical path contractors or whatever it is that they know will complete the project effectively, they have a good track record? Are you seeing that there's maybe a little bit more understanding to negotiate these right now, or is it still challenging to have these conversations?
That's an interesting question, and I don't think that discussion is ever confined to a hard market. You get those discussions all the time, from smaller contractors that can't afford the $5 million. They want to, they have to, they don't want to pay the extra for the contract.
Yes.
And that's, I don't know that's an answer that you can give that's just across the board at this point. I think it's situational. If my, if there's a more dangerous contractor, or more, I shouldn't say dangerous, but a contractor that's doing more dangerous work like roofing, wants to cut back on their limits, I would think that most general contractors would have a hard no, right? That's not going to happen. It's really situational. If you're, your guy that's installing carpets, contractually he's required to 10 million and he doesn't have the 10 million, I think that they would be a little bit more understanding of that. And it's, it's really, it's a situational issue. I don't, my opinion is.
No, I would agree with that. No, and which lends itself for me to say to the contractors listening to this, that you need to be having these discussions because it is situational, and you need to be having these discussions with your clients, with owners and your upstream parties, early on in the negotiating process, or even when you're receiving bid docs and having a discussion and engaging in that discussion in advance.
Nick, you buy insurance for two reasons, right? You buy it because you contractually have to, or because you're afraid that you're going to have a loss and you figure that number is going to cover your loss. The first reason, you talk to any contractor and you'll get an ear lashing for 2 hours, right? I have to do this. Nobody wants to be told they have to do anything. It's the second reason that is much more concerning, because you have to remember that the contract that they're signing has an indemnification, and that indemnification doesn't say that we're going to go after you just for your limits of insurance. It says that you will indemnify us for any and all issues that occur, and that could be, $2 million, that could be $200,000, that could be $200 million, right? I was just on a call the other day. We're talking about a management claim, but it was $1 billion loss. $1 billion, right? And I'm not saying that that's going to happen to anybody.
Yeah, but
the point is, those numbers are out there, and so to your point, the discussion becomes less about the cost of the insurance, because the truth of the matter is, labor is going up, materials are going through the roof. I don't know if you had to buy wood recently, but
$9 a stud.
those numbers are through the roof as well. So it's not just insurance that the contractors are dealing with, and that's just creating more pressure on their budgets.
Hi,
Thank
gentlemen. Don't mean to interrupt. We have about a minute left, coming up on that minute for the rest of the panel, and then we'll go into Q&A.
Thank you, Debbie. So to wrap things up, Jeff, I'm going to turn to you. If you had any piece of advice to give to a contractor prior to their next renewal cycle, what would you advise them of at this point?
Yeah, I appreciate that. It's a lot of the same stuff that we've kind of been talking about for the last 45 minutes. It's, the process has slowed down, so we need to start early. It just takes more time. And then the communication and the quality of the information becomes paramount, right? We need, as Nick mentioned, we work with a lot of different retail agencies and see submissions from all kinds of different folks, and they vary widely in terms of quality of information, where they get conflicting figures and conflicting just information. And when you present that to the underwriter and it's incomplete and they can't make heads or tails, and there's not a good narrative, and there's unexplained losses, they're too busy. They just, as Glenn said, they throw it over their shoulder and move on to something else. If you can put something in front of them that says, this is where we're at, this is what we need, this is what we want, this is what we do, this is, these are maybe the problems you might see, or the kind of hurdles, but this is what we're doing about them. This is this is the corrective actions. These are the mitigating circumstances. These are, the proactive things we're doing. It makes a big difference.
Glenn, what are your parting words for a contractor? If you had to give somebody advice prior to their next renewal cycle, what would that be?
Yeah, I think that being truthful with your broker, understanding, so that you understand what the real risks are, and coming up with a story to tell the underwriters that puts you in the best light, and understand how the how the market is going to affect your your year, and hopefully you can do things within your within your program that maybe find some cash flow things to do. For instance, obviously you're going to pay your full freight on workers' comp, but if you have a large payroll, you might pull back a little bit on that. That makes the upfront go down a little bit, but obviously you have to be very, very, very careful to make sure you don't spend that money, because it's going to come due. It's just a matter of cash flow. So finding cash flow opportunities might be very helpful, and and just know that the market's going to turn again, and things will be rosy, hopefully very soon.
Gentlemen, I appreciate your time immensely. Thank you very much. I'll let Debbie jump in here, and thank you everyone for being on the call this morning with us. We appreciate it. Again, we've got Jeff English with CRC Insurance Services, Glenn Pine with TSIB, myself. As the gentlemen both mentioned, have discussions with your broker early. Disclosure, 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 disclosure. You need to talk about everything thoroughly so that we can put you in front of an insurance carrier as the best risk possible to get the most affordable rates that are available in the market. Thank you.
That was great, gentlemen. Thank you so much. So let's open up with our Q&A portion now. As a reminder to the audience, you can post your questions in the chat feature located at the top right of your screen, okay? We do have a question here off to start with. Are rates going up for every trade, or are some trades seeing greater rate increases? Gentlemen?
Jeff, do you want to take that one?
Yeah, I mean, I would say rates seem to be going up for every trade. It's less isolated by trade and more isolated by kind of loss experience, residential exposure out here in California, and kind of some of the other factors that might go into it. But obviously, as Glenn said, a higher hazard operation like a roofer is going to experience a higher starting rate than, you know, a commercial electrician or something. It's just, I would not say it's isolated to one particular trade or that they are being vastly treated differently. Street and road might be an exception. They do seem to have a harder time with some of the excess capacity and some of the other things, but.
Okay, great. Another question that has come in. We have never had any claims. Is there anything we can do to avoid rate increases?
I'll jump in on this one if you guys don't mind. That's a really good question. So there's different types of insurance products out there, and you can start with what most folks are familiar with. You have guaranteed cost insurance, and guaranteed cost insurance, in short, is an insurance product which you're all accustomed to. And just think of your personal car insurance as the best example. In the beginning of the policy term, the carrier will charge you a set rate. You pay your premium during the policy term, and whether you have claims or do not have claims during that policy term, you will not have to pay any additional money. Obviously, you'd have to pay a deductible at the time of loss if you have a deductible, but there is no retroactive, you owe the insurance company more money because you had a loss, right? The rate is set no matter how many accidents you have during that policy term. And then there's other, we refer to as performance-based or alternative risk financing methods, where you as the insured can get into a retrospective rating plan, an SIR, self-insured retention, or large deductible plan, or you can start self-insuring and obtain insurance through creating your own single parent captive, or participate in a group captive where you literally become your own insurance carrier and you share in the losses. And ultimately, if you have gotten to size, and I usually advise clients that when you get to about a $250,000+ spend on insurance, that's kind of the really beginning of the starting point of where you can start looking at more performance-based products, where you as the policyholder are going to accept more of the first dollar risk and take less of that burden away from the insurance carrier, so that way you can benefit from your own performance more, rather than being part of this global underwriting where XYZ carrier is underwriting for the losses of thousands of contractors out there that are in the same risk pool. So yes, there are alternative methods of structuring your insurance program so that you can gain the benefit of being a well-performing risk, if that makes sense.
Great. Another question's just coming in. Has the COVID pandemic made the situation worse?
Yes.
Yes, and so real quick, I'm going to turn to Jeff. Jeff, from your perspective, right? You're dealing with carriers all the time. Other than, I think it's safe to say that everyone has experienced the COVID delay, as I'm eloquently referring to it, as people working from home, trying to work with technology they've never used before. So there's been obvious delays that we've seen. And I think we can all be honest and say the insurance industry is probably one of the slowest industries to adopt new technologies. So that's kind of added to some of the delays. But has COVID actually impacted the underwriting process and the way carriers are viewing risks?
I don't know that it's, I mean, we're seeing communicable disease exclusions first and foremost, kind of on everybody across the board. And there's a lot of resistance to get those removed. So that's kind of a very low-hanging fruit example of how it's been impacted. You mentioned the delays, construction projects. We're seeing, I mentioned builder's risk earlier, not only in materials delays coming overseas, or, windows especially seem to get delayed all the time. We're also seeing that, especially in LA County and some of these other ones, it's tough to get an inspector out to sign off on different things. And so projects keep getting delayed, costs go up. It kind of becomes a pain. As far as the underwriting side of things, I would say that the harder market has had a bigger effect on the underwriting process than COVID has. Most of our folks transitioned pretty well to working from home and are still very much accessible, but the flow and the underwriter dynamics have affected the underwriting process in a more significant way, I would say.
Okay, great. And I don't see any more questions in the chat. So I think we're going to be wrapping up here. I just want to thank everyone again for spending time with us. Don't forget to join us for our next session, Hard Market Solutions. That session's links can be found on the seminar program page on TSIB's website or the reminder event email that you received. See you in a bit. Thank you again for joining us.